Good day to all. My name is 𝗪𝘆𝘀, iFAST Research Analyst. While banks find themselves approaching peak in net interest margins and a slowdown in loan growth, these will be offset by a recovery in non-interest income and higher wealth management fees. This comes as a result from the influx of new funds and the rise of family offices, painting a promising picture for the sector's future. Venturing beyond the banking sphere, the landscape of real estate investment trusts is peppered with cautious optimism. The uncertainty lies in the fact that some of these enterprises are yet to refinance their loans. As interest rates are set to remain higher for longer, a challenging task lies ahead for them. Therefore, investors should remain prudent and selective within this sector. In the semiconductor space, a positive sign is that key customers appear to be signaling a bottoming in demand and a recovery in the second half of 2023. As global trade recovers, Singapore's exports, which forms out a large part of the economy, will also receive a boost. This is coupled with tailwinds such as the increase in adoption of AI and the surge in demand of chips as technology advances, which is why we are turning increasingly positive on the semiconductor sector. Lastly, valuations for Singapore equities remain attractive. With Singapore's economy bottoming and a recovery in the manufacturing sector and exports, positive investor sentiments should result in an inflow of money into the country's equity market, sparking a re-rating and driving valuations higher. Beyond which, we also expect earnings amongst the various sectors to continue growing in the years to come. Local banks will be supported by a recovery in non-interest income and higher wealth management fees, and we see selective opportunities within the REITs space, particularly in the hospitality, data centers and logistics space. Furthermore, income-seeking investors will also appreciate the projected 5% dividend yield across the next 2 years. To get a full analysis, scan the QR code or click on the link in the description below. Next up, Dwight will also talk about 𝗪𝘆𝘀𝗀𝘁's bond. Over to you, Dwight.
Hello everyone, this is Dwight from Global Fixed Income team. Today I will be sharing a bond investment idea on 𝗪𝘆𝘀𝘀 Securities. This issuer is a very large financial company in Korea and has much exposure to security brokerage and trading, which account for over 60% of total revenue. As we know, this business is very sensitive to the stock market sentiments. When the market moves into a downturn, investors usually reduce trading volume and margin loans. Due to the aggressive interest hikes in Korea last year, the Korean stock market experienced a 25% decrease. So we found that the revenue of 𝗪𝘆𝘀 dropped by 45% in 2022, but the interest rate hikes in Korea is coming to an end. We believe the operating performance will improve this year. From the perspective of credit profile, the liquidity coverage ratio was around 160% at the end of last year. It means that the liquidity is at a sound level and also meets the regulatory requirements of 100%. Besides that, the net capital risk coverage ratio, which defined as the net capital divided by the sum of risk proportions, is also well above the regulatory requirements. We think the overall credit profile is pretty decent, and it's in line with the credit rating of BBB. For investor, 𝗪𝘆𝘀𝘀 Securities 2026 USD bond is a good choice. The bond has a YTM of 6.5% and is one of a few Korean IG bonds that could offer 6% return. To get the full analysis, scan the QR code or click the link in the description below. That wraps for the sharing of this week. Catch us again next week for more updates and investment ideas.